Alright, let's get started. Welcome everyone. Over the past week, I've been working on this turtle trading backtesting experiment. So basically, what I've done, I've read the book Turtle Trader before, and I tried to implement the strategies using tools and programming to see whether, to answer the one question, whether turtle trading still works in 2026. So, for a brief introduction to what turtle trading is for those who don't know, I've actually made a video about turtle trading, but I don't recommend that you watch it because it's not a very good video. Instead, you can read the book shown here. I'm not sure if I'm covering it. No, I'm not. This book right here, Turtle Trader, it's quite an interesting read. The book doesn't just cover the strategy itself, it actually covers a lot about this fella here, Richard Dennis. It's quite an interesting character because his strategy is very systematic. He talks a lot about emotional control and not going off, because he says a lot of traders they think they are above the market and like to make their own decisions, but this strategy, it actually hurts if you go against it. So I thought, why not make it into a program, make it into an algorithm. So yeah, that's a brief intro into what turtle trading is. If you want to find out more, you can read the book yourself. It's a good read. So how have I split the video? I'll make sure to include timestamps up on the screen here, somewhere. But I'll talk about the process, including the tools I've used and the thought process behind certain decisions I made. Then I'll go into the performance of each iteration. So I'll take you through the various versions that I've gone through for the backtesting algorithm, and finally I'll show you the end result, the final performance, some analytics for the final strategy, as well as the improvements I can make and my thought on the whole thing. Right, let's dive. Okay, wait, before anything, a quick disclaimer: I'm not a financial professional, so please don't take any of this as financial advice. Even if you do, I doubt you stand to gain much from it, as you'll soon find out. And also, I'd like to preface, I'm not a very good trader. My extent of trading, pretty much just buying monthly ETFs. And what else? I am average at best at programming, so yeah, take everything with a grain of salt. There may be some mistakes here and there, but I've tried my best to make sure that everything is as accurate as possible. Let's get it. Alright, so version 1, we started with the bare bones version of the turtle trading. So pretty much it boils down to having an entry at the 4-week price breakout and having the exit at the 2-week price breakout in the opposite direction, right? And the tool I used to perform this backtest was actually Backtrader, because I did a data chem course and it introduced the idea of Backtrader, and I didn't want to do it from scratch because I think that would be a lot more time consuming. I don't think it's worth reinventing the wheel if these tools are already made available. I think just as a beginner, I'm prone to make a lot more mistakes if I were to make it from scratch. So I'm using Backtrader. And Backtrader, their wiki is actually really helpful. They have a lot of, from here, their wiki here, you're able to see cerebral concepts. You're able to find out the different strategies and indicators they have. And they have built-in commission schemes and observers, and it's already very helpful and easy to use. And that's how I got started as well. I just copied a bunch of their code from their quick start guide and replaced it with my own. Starting with the EMA crossover and then working from there. It made it really easy. For those who want to get started with Backtrader, I do recommend it. My quick tip: Cerebro is basically just the brain of it, and the most important method inside the class is the next, which goes through each day or each bar for the data feed. And also, what I did was I created a dictionary at the start for the different. I'm not sure if you can see. For the different you make a dictionary at the start, and you store the different information of the different takers into a dictionary, so that it's easier to access as in the initializing phase. Alright, that's all I'm gonna talk about for Backtrader if it's too much. Okay, the 4-week entry and 2-week exit. So the code is here. It's actually quite straightforward. So you can see if it's not in a position, you see whether the close is higher than the 4-week high, and if it is, you buy. All these other stuff is just it sends a message to view, like in the inline, and then it sets the order to true, and actions dname is pretty much for my dictionary, so you can see what actions were taken that day. Is that right? Yes, it is. And the get size function here, I'm pretty sure at this point I was just using 10% of my total portfolio or total portfolio value, so don't worry too much about that yet if it's not in a position. So you can only trade when it's not already in a position. Sorry, if it is in a position, then if the close price drops below the 2-week low, then that's when you sell. So the performance, it managed to gain $11,000 in returns, a Sharpe ratio of negative 0.32, sorry. The win rate is actually quite high, 57%. So that's good, right? But it's only 14 trades, and it's from 2016 all the way to 2026. Okay, this data is from the S&P, and it's from 2000 to 2026. So 26 years, and you only have 11% returns. So even though the win rate is quite good, and the average win is actually far outweighs the average loss, it's just so infrequent that you might as well just buy and hold. But then we get to the version 2, where we start to add the core functionalities, which is the end value and pyramid. So what is the end value? Pretty much the end value is just the 20-day moving average of the true range. And this end value is actually used for multiple functions across the strategy. Firstly, it is used for, it's used for the pyramid function, of course. So what's the pyramid function, right? So the pyramid function pretty much states that when you're in a position, whenever the stock moves up one N, so one true range of the stock, you add to the position by buying another unit of the stock. So you can see this graph here. I hope I'm not covering. I might be covering. So this graph here, you can see how it's like a pyramid shape. It goes up and up as the stock price moves up, and you limit the number of pyramids at 5. So after 5, you stop it there. The end value is also used in the stop loss. So in the book they said 2N is the stop loss, so you set the stop loss at 2N levels, 2N price below the entry price. Similar to the pyramid, every time you add a unit of pyramid, it goes up by 1. So you can see this red line here, it moves up along with the green color line, which is the pyramid. And once it goes past 5, even though the number of pyramids stops stacking, the stop loss still continues. So it's like you're limiting your stop loss and you're maximizing your gains. And that's what the whole strategy is about. It's about riding a wave. You can see it's like almost like a wave here, and it's a trend trading. So the stronger the trend, the more you stand to gain, obviously. So let's see the results. Oh yes, I forgot to mention the get size function here was actually coded really wrong. I can explain this better later on, but here I use 2% of the broker value, and I use the contract risk of n times 2 on the SPY ticker, because that's what they stated in the book, right? And then we got the number of takers, the number of shares to buy by dividing the account risk by the contract risk. So like 2,000 or 20k divided by however many n times 2 is, however much n times 2 is. Now the problem is that in the book, n is actually the actual stock's price or the futures price. Okay, this part I'm not quite sure, but it's a lot higher, so the n value is much higher. So the number of stocks they buy becomes much lower. except the SPY here, the ATR, most of the time it isn't very high. It's like 0 point something, 0 point, it's a very low amount. So pretty much you get 20,000 divided by a super low amount and you get a ridiculous amount of size. So you can see here one of the buy executions, it buys $87,000 worth of SPY stocks, which is what, 87% of the portfolio. That makes no sense, right? Like, that's way too much. That's not proper capital management. And so the win rate drops because, did the win rate drop? I'm not sure. It did. Oh yeah, it resulted in one more trade. I believe it's because of the pyramid, but the average win and average loss are way overblown because of this improper sizing. So keep that in mind as we move on. Alright, version 3, I added going short, the filter rule, and the system 2. So going short, so before this I've just been making the program run by taking long trades only. But actually you can use the same rule, you can apply the same rules in the opposite direction and you get similar results. Right? So I think that's pretty self-explanatory. You're going short, so you see if it exceeds the 4-week low, you buy, and the stop loss is at the 2-week high. Okay, and the filter rule. What's the filter rule? The filter rule, it says that if the last trade was a winner, then you skip the next trade. And if the last trade wasn't a 2N loss, meaning if it hit the 2-week low or the 2-week high instead of the 2N stop loss, then you don't buy it. And I was actually quite confused at first. I'm like, what's the point of this? But you start to understand as I show you the chart later on. System 2 pretty much it builds on this filter rule. So sometimes if you skip this trade, that let's say the last trade was a winner and you skip this week's trade, and then it starts going into a trend, right? Like you don't want to miss out on the trend. You use a system 2, which is the 11-week, which uses an 11-week entry and a 4-week exit to make sure you don't miss out on trends. So yeah, that's pretty much the base of it. And let's see the results here. A lot more red lines here, ignore all those. Okay, so now we got a bunch more trades, 43 trades, and the win rate goes way down. You expect the performance to get better as you add more features, right? But it's not the case here. In fact, it's not gonna be the case for the next few versions as well. Or the next version, I'm pretty sure. But okay, but here you start to understand why Richard Dennis was so hated, or why Richard Dennis implemented some of these rules, right? Filter rule, system 2 rules. It's because there's so many false breakouts, and I'll touch on this more later on. But pretty much the filter rule was there to stop having false breakout and to minimize the number of losses, right? You see here, 16% win rate, even though the average win is like 5 times more than the average loss. It only wins 16% of the times. You need 20%. You need to hit 20% to make it break even. So the filter rule is really trying to filter out like unnecessary trades to be taken, right? Okay, let's go. Final version. Okay. Okay, the final version, we added portfolio rebalancing and proper capital management. So what is portfolio rebalancing? Portfolio rebalancing is pretty much, so before this I've just been using the SPY ticker, but in fact the book stated that they actually trade a bunch of different commodities and futures in their strategy, including like bonds, corn, oil. A lot of these are highly correlated, right? Like gold, silver, and copper. Most of them are quite strongly related. So if you were to trade both of them at the same time, you're actually doubling the risk you're taking on. So the rule is pretty much that if you already have a ticker, if you're already trading a ticker within that one group, then you just stop trading a group entirely. So you can see here, it is active in a group, then you skip it, right? By trading across these various groups, you're actually maximizing your chances of riding a wave while minimizing the risk you're taking on. And the next part of this, proper capital management. Downside protection, drawdown protection, I mean. So pyramiding has its drawbacks, which is what I mentioned earlier. If no big trend materializes, so if there's many false breakouts at one instance of time, then it will start to eat away faster at the turtle's limited capital. So what Richard Dennis did was that for each 10% drawdown in their starting balance, it reduces their unit risk multiplier by 20%. Initially, it was set at 2% of their total portfolio to be traded, like maximum. But let's say if you lose 10k, so starting from 100k, you lose 10k, now you're at 90k, that unit risk multiplier gets to 1. So it's 20% less you get to trade. I hope I'm making sense here. 20,000 you get to trade drops down to, sorry, is it 20,000? Alright, whatever. 2% you get to trade drops down to, I believe, let me do the math real quick. Okay, it's 1.6%. And if you lose another 1,000, I mean if you lose another 10k, then you drop down to 1.28%. So you're limiting your losses as you go down. So yeah, this worked way better than the previous one of just trading 10%, I believe. 10% of your total trades. But I had to add an extra step here because I wasn't trading future contracts. So the math didn't really work for me. I added this max position percentage, which multiplies the max risk per trade, which is 2% of your account, by the unit risk multiplier. And this is pretty much a cap. Because if that contract risk, like I mentioned earlier, if the N is way too small and the risk size becomes exponentially large, right? Becomes like ridiculously large. Like if you're buying 10,000 shares and it gets too ridiculous, the max position percentage comes in to limit that, and it pretty much acts as like a fail-safe. You use that to multiply the value instead, divided by the stock price to get the number of shares you buy. And I'm pretty sure this got used more like 99% of the time because the end value was just too small on a lot of these tickers. So yeah, that's pretty much it. Drawdown protection and portfolio rebalancing, and I believe that was all the features in Turtle Trading. So let's look at the final results. Bam! Oh my god, what are we looking at? Yeah, because we added so many fucking tickers, the chart is no longer legible. You can't even zoom in to see the number of trades. So instead, I made a log trade function, so you can see like a trade table here, and you can see the direction, the entry dates, the size, the exit reasons. It's a lot easier for me to see the trades and their reasons and to analyze. So for the final result, we got a total return of negative 6.32% over, was it 2016 to 26? I'm not sure. Oh wait, no, it's here. 96 to 680. I'm pretty sure it's from 2000 to 2026. Something like that, or 2011 to 2026. The alpha against the benchmark, negative 600%. Yeah, you're better off just buying and holding. The win rate of 12%. Okay, but here's the thing. The average win is so much more than the average loss. You know, I'm starting to understand. You start to understand Richard Dennis's. You start to understand the book more. You see here, it's 5 times more. But unfortunately, the win rate is not high enough to accommodate that. The infrequent lot. What am I saying, bro? The infrequent wins. You start to understand Richard Dennis. You start to understand why he added all these features in place and why his clients hated him so much. Because how big these losses were. Alright, let's look at the stats and analyze. So you can see here, obviously, this was what I mentioned earlier. Can you see? Please tell me you can see it. I'm not blocking the screen. Okay. You can see most of it lies below the 0 mark. So most of them are actually negative. And there's only a few handful, and there's some like outliers here. If you look at the tail, there's some that goes to the 3,000 range, but most of them lie within here. Which is why nobody liked Richard Dennis. No, I'm sorry. Which is why his strategy was so so infuriating, and why so many people couldn't stick with it, right? It's so frustrating to see so many losses and only have a few. But those large P&Ls are really like, woo, you know? And win rates by pyramids, so obviously this is natural, right? The more you stack, the more you're bound to win. Okay, but here's what confused me at first. Here's where I got the math wrong. I mean, because the stop loss is 2n and the pyramid was 1n, right? I thought that you only had to go. I thought 2 pyramids would guarantee that your stop loss would be kept at the original price. That's what I thought. So it's impossible to lose money from 2 pyramid onwards, right? But that's not the case. I didn't take into account the volume weighted average of the prices. So let's say your entry price is 100, right? And your stop loss is at 90. If you go up 2 pyramid units, okay, let's assume n is 10. So it's at 120, and wait, let me try to think. No, stop loss is at 80. So 100 plus 10 plus 10, you move up 2n, right? 2 pyramid units. So it's at 120. Now you buy 120. So if you buy at 100 and you buy at 110 and you buy at 120, the volume weighted average price is actually 110 plus 120 divided by 3. It's 110. So if you hit the 100 stop loss price, you're actually down $10. And similarly, if you do the same logic for the third pyramid unit, so 120, you're still losing $5. Okay, so pretty much it just means that you don't break even though you go past multiple pyramid units. And 5 onwards really just means that the stop loss is set really high, and that's why you have a higher chance of profit. And 5 probably means that the trend you're on is actually really strong and the momentum is really strong, and that's probably why you're able to capture a profit for those. Here are some more stats, some interesting stats. The win rate between the long and short is actually quite similar. No shock about that. Trends work in both directions, so the win rates are similar. That's win rate by system. System 2 is slightly higher than System 1, which is to be expected. System 2 is a lot more robust. 11-week entry is probably a lot more indicative of a strong trend compared to a 4-week breakout. Oh yes, okay. And I was quite skeptical of my results at first, so I used TradingView's Pine Trader to replicate this strategy as well, and it showed similar results at 31% win rate. Quite bad returns, but maybe I'm just doing it wrong on both, I'm not sure. Okay, to conclude, this strategy obviously does not work. Or at least it didn't work as it mentioned, like it did in the book. But that's to be expected, right? I mean, the book was based in the 1970s to 1980s. There's a lot more algorithms now that captures trends a lot faster. So there's not a lot of time for you to ride the waves like Richard Dennis's strategy. And another reason I believe hindered this strategy was that I wasn't using futures because I didn't know how. Futures actually amplify your gains a lot, so perhaps in the next time I could learn and implement futures trading into this. But yeah, it's a fun experience overall. You start to understand the strategy a lot more. You start to understand why he implements some features like the filter rule, like the system 2 rule. It makes a lot more sense after you create it yourself. And it's fun, it's fun learning the back trader and fun seeing the returns and the metrics, right? Yeah, that's it. Oh my god, I've been covering. I'm so sorry. Do you need to see? Oh my gosh, I've been blocking the results. Oh no. Here. Yeah, that's about it. I'll make sure to link my files and my results in the description below for anyone to critique and check for errors and suggest improvements or anything, to be honest. I really appreciate it. Thanks for watching this video. Goodbye. Was?